There's my email as well. So let me give just an ever so brief background about myself, and then we'll dive into it. So I've been doing exchanges now for more than 15 years. Um, I actually had my own 1031 company. It was acquired by Fidelity, and I came on board as a partner with IPX 1031 Exchange, and I own the franchise for the states of Colorado, Utah, and Wyoming. In a prior life, I was actually an economist with Credit Suisse out of Zurich and London and New York, and then worked in mergers and acquisitions, corporate finance for Merrill out of Hong Kong and Sao Paulo and New York. So I like doing presentations about taxes and the economy and stuff like that. So that's enough of a background and introduction. Let me just tell you a little bit about our company. So this is our website. I think it's a pretty good website. It's very user friendly. We have a resources tab. You can actually start a 1031 exchange without ever talking to a human being if you'd like. You do it right online. We also have calculators that'll figure out your 45 and 180 days. Calculators will also figure out your capital gains. I will admit that the calculator on the capital gains is not as good as if you called me, because it makes assumptions about depreciation and all that. I can actually walk you and your client through that calculation, and they'll understand it in about 3 or maybe 4 minutes. We also have a knowledge center that has topics on any 1031 question or issue that you can think of. We also have little videos, 2 minute videos, several of them. They're on the homepage. If you ever want a little quickie on a particular issue, just watch those 2 minute videos. Of course, we have all the brochures and reference materials. We also do webinars through the website, one on basics, one on advanced. We do them each month, but they're not for CE credit. If you want a CE credit class, give me a call and I'll do that. I think that's it for introductions. I already said that I have the franchise for the states of Colorado and Utah and Wyoming. And again, we're part of that Fidelity group, meaning that we own Alamo Title, Chicago Title, Commonwealth. In Colorado, Commonwealth is called Heritage Title, Fidelity, Lawyers Title, Ticor, and we are the largest title insurance company in the world. 1 out of every 3 real estate transactions is done through Fidelity, and we are part of that group. But we do exchanges for any and all title insurance companies. All right, I think that's enough of an introduction. Nina, am I talking too fast? I've had 3 cups of coffee already this morning. Am I doing all right?
Yeah, you're doing fine. And I told people, would you like people to put questions in the chat or ask you during the presentation? What's better for you?
Either one is okay for me, whichever the people are comfortable with.
O-
And if we end up taking too much time on a particular question, don't worry. I can tell them we'll answer it offline and get back on the track, so to speak.
Okay,
What
so
you're seeing,
I'll just tell people, if you have a question, go ahead and unmute, and at the appropriate time, go ahead and ask it. And then we ask that you mute again so we don't get a lot of background noise.
yep. And so sometimes people like having questions via the chat room. They feel a little more anonymous, maybe, or something. That's okay too. So these are all the sources of my information. I just wanted to be able to show you that. We're going to do the proposed tax changes. I put inside of it some little bit about 1031 exchanges. So hopefully that structure is going to work. And here we are, we're off and running. So uh, this actually, let me explain this. This is going to be our template as we move forward throughout the presentation. The far left-hand column, the black column, are the 6 major broad proposed tax changes that are being talked about by the Biden-Harris administration. The next column over, green, labeled Biden, those are all the proposed changes that they want to do. And then the far right column is the Tax Cuts and Jobs Act. In other words, this is what the current tax code is since 2017. All right, knowing that lay of the land, let's take a look. The Tax Cuts and Jobs Act was passed by President Trump back in December of 2017. It reduced individual income tax rates across the board. 85% of all taxpayers got a reduction in taxes. Corporate income taxes were reduced from 35 down to 21%, and that incentivized more corporations to relocate in the US and increase the number of jobs and raise wages for employees. Personal property 1031 exchanges, my business, were eliminated. Now, today, all we get to do are exchanges on real property, real estate, but includes things like oil and gas, water rights, air rights, minerals, leases. So real property. And the estate tax was reduced and the estate tax exemption was increased under TCJA, the Tax Cuts and Jobs Act. All right, so here's what's happening. The previous Democrat primary candidates, Senators Sanders and Warren, wanted a wealth tax, a 2% tax on people that have $50 million of wealth or more, and a 6% wealth tax on people $1 billion of wealth or more. Biden does not want to do that. He instead simply wants to raise taxes, personal income tax rates, corporate, either repeal or maybe limit 1031 exchanges. He's going to raise capital gains taxes and he's going to raise estate taxes. All in all, this is a $4.3 trillion tax increase over the next decade. And Senator Warren is back. She has just introduced new legislation as of February 3rd, last Wednesday, about this wealth tax. So it is on the table as to whether or not that's going to be in the mix, as well as raising taxes on the stuff in red that I just listed. Okay, a little bit of information in terms of the political resource. No politics, just knowing what the political resources are. Everybody knows, I think, that both Senate seats in Georgia in the runoffs on January the 5th went Democrat to Ossoff and Warnock, and now the Senate is 50-50. So in tie votes, the Vice President of the United States, Harris, will cast the deciding vote. She is the President of the Senate in tie votes only. With the Senate being at 50-50, any changes to the tax code would normally require a 60 vote majority. So if 9 or so Republicans were to defect, quote unquote, then there could be changes to the tax code. However, budget reconciliation, sort of called the nuclear option, has already been used. It was just used 4 days ago when they used budget reconciliation to pass the coronavirus debt relief of $1.9 trillion. In budget reconciliation, only 51 votes are needed to pass legislation. And of course, Vice President Harris would be that 51st vote. All in all, in the current political environment, I think there's a strong likelihood of a significant change to the tax code. So questions always come about at this stage. When will this happen? There are, as far as I can tell, two different schools of thought. That the tax changes will take, them to digest, and the Senate and the House putting everything into place, that they won't actually introduce legislation until maybe the middle or the end of the year, meaning that these tax changes won't go into effect until next year, 2022. Others think that the changes will take place sooner and that they even could be retroactive and in place for this year, 2021. I'm in the former camp, not the latter, but there's always surprises when you're talking about Congress. So this budget reconciliation, they're allowed 3 uses of it in any one calendar year for the Congress. They can use one on spending, which they just did. They can use one for revenue, that would be this tax changes, and they can use one to address the federal debt ceiling. So we'll see what happens. All right, let's dive into what some of these changes might be and that they've been talking about for quite a while. So number one, talking about 1031 exchanges, 2 completely different possibilities. They have talked about completely eliminating Section 1031 out of the tax code, or just restricting 1031 exchanges. And that restriction, if they just limited 1031s, would be the following. Only those people that earn 400 grand or less would still be able to use Section 1031 to defer their gains on the sale of investment real estate. People making 400,000 and above no longer would be able to do a 1031 exchange. Here's one of the problems. That $400,000 number is not defined. We don't know if it's married filing joint. We don't know, if that's true. That would mean that someone single filing, as a single tax filer, they would be at 200,000. So would that be the case? What about taxpayers in LLCs or partnerships or sub S's or corporations or anything like that? We just don't know because the $400,000 threshold is not defined. We also don't know if it's relating to last year's income or the current year. So now's a good time as any, I think, to talk a little bit about 1031s. So Biden's plan, it's called Mobilizing American Talent and Heart to create a 21st century of caregiving and education workforce. It creates brand new spending of $775 billion on the elderly and on childcare. And to help fund this new program, they would propose that they repeal or severely restrict Section 1031 exchanges. The Irving's Brookings Policy Center said that if they did that, it would generate maybe 14 billion. Dynamic cash flow models say that that really would only generate about $9 billion. So does it make sense to repeal 1031s to generate about 9 to 14 billion dollars and then turn around and spend it on new spending of 775 billion? I don't know. Let you guys answer that question. So 1031s are a significant part of the real estate economy. Over $100 billion of 1031s were done in 2016. That's the most recent year that we've got data. 1 in every 5 residential sales, 20%, are driven by a 1031 exchange. 1 in 3 commercial real estate sales are driven by a 1031 exchange. And when you look at larger deals, 30 million and up, this stat becomes about 1 in 2 commercial real estate deals are driven by a 1031 exchange. I think I need to go a little bit faster because I only have 30 minutes, not an hour, right, Nina?
No, we have this till 9:30. And again, if people want to ask questions throughout, so, kind of our hard stop is 9:30, but I do have a question.
Sure.
You see the one exchange, if you see the Biden plan going through, do you see that suddenly that's going to limit the number of homes that will come on the market for sale? Because I think people will then just say, I might as well just hang on to this property versus selling it and paying the capital gains. I mean, what's kind of your prediction?
That is exactly right. You're going to see after we get done talking about 1031s, about how they're going to raise individual income tax rates, and then they're going to raise long-term capital gains. It's going to be a huge disincentive to sell property. And yeah, I think that'll just drain what little bit of supply we may have out there. Of course, commercial real estate is more affected. It's affected by supply, inventory, but cap rates are always directly related to interest rates and rent rolls. So it would probably affect residential more than commercial. So I'm in agreement with you. It would shrink supply. Good enough?
Yes.
Okay. So I'm going to take a little bit of deviation because you wanted me to talk about 1031s in general for the audience. So section 1031, or that little squiggly thing, means section. It's called the non-recognition of gain. I mean, what does that mean? It means if you got someone that's selling investment property, not the sale of your home, and they've got a gain, let's say the gain's 100 grand, guess what? They're going to have to pay taxes on that $100,000. That capital gains tax is 30 to 40% right now today. Where in the world is that 30% coming from? Because if you know anything about capital gains are only 15, maybe 20% if you're in a really high tax bracket. Well, that's true, 15 or 20%, but there's also the recapture depreciation tax at 25%. And you're going to have to pay the Affordable Care Act or the Obamacare tax, 3.8%, and the state of Colorado at 4.63%. All those capital gains taxes, 15, 20, 25, 3.8, 4.63, all those added up, they blend together so that the effective or blended tax rate is usually 30%. Where's the 40% coming from? Well, look at the very last number, 4.63%. That's us, that's state of Colorado. What if you get a client that's selling property in California or New York or New Jersey or Illinois or Iowa? Those are high tax states. For example, California, the highest marginal rate out there is 13.3%. Compare that to our little 4.63%. then the effective capital gains rate for selling real estate is no longer 30%. It pops up to about 40%. All right, but all of those capital gains can be avoided. They can be deferred by doing the following, by doing that 1031 exchange. But I need to make sure that we get something out of our minds. We're not talking about the sale of someone's home where they live, the personal primary residence. When you sell your home where you have lived, as long as you've lived there 2 out of the most recent 5 years, then you can exclude, not pay taxes on gains up to $250,000 if you're single. If you're married, you get up to $500,000 of gain tax free. And you get to use that exclusion over and over and over once every 2 years. So 1031s are not for the sale of your home. You get a better deal when you sell your home. It's tax free in most cases. Okay, but if you do an exchange on investment real estate, follow the rules and the timelines, and then you buy some other property, and you can exchange into multiple properties, by the way, then guess what happens to those gains? Those gains are deferred. They roll over into the new property. I just want to see my graphics again. They're pretty good. Big gains get deferred, and you don't have to pay those capital gains taxes. All right. Accounting wise and 1031s, I just want you to note something. You buy a piece of property for 150 grand, and this is not realistic in today's prices, but it does make the math a little bit easier in our brains. Buy something for 150, you rent it out. Years later, you sell it for 200,000. You tell me, buy it for 150, sell for 200. What's your gain? I'm ignoring commissions and closing costs. The answer sounds like $50,000. Well, actually, when you do an exchange, here's what happens. That basis transfers from the old property into the new, and the gain rolls over into the new property. And that's the whole idea behind doing a 1031 exchange. Looking at this a little more clearly, you buy a property, let's say you bought it for that $100,000 price, rent it out, sell it 5 years later. Everybody, most of your clients are thinking, hey, I got 50 grand of gain. I'm here to tell you, this is one rule you can walk away from this session. Whatever you think the gain is, it's a considerably more. Here's what it looks like. That original purchase price of 100,000 has been shrinking down to $82,000 in this example. On paper, accounting wise, that's the adjusted cost basis. You take the purchase price, you depreciate it over 27 and a half years. That's about $3,600 of depreciation expense each year. You do that for 5 years. You've got $18,000 of total accumulated depreciation, and you subtract that from the purchase price and you get that adjusted cost basis. The point of all this math is you don't have to know this. If you ever want me to calculate it, or if you want a client to understand it, call me up. But the point is, the gain is, by the way, residential property is depreciated over 27 and a half years, commercial real estate over 39 years. The gain is actually made up of 2 capital gains. Gain from the appreciation, which is 50,000, the gain from the depreciation recapture, which is 18. So the total gain is $68,000, significantly more than what you originally thought. And here's what the taxes look like. The gain on the appreciation is either at 15 or 20%. The gain on the depreciation is 25. Both of those gains get taxed at 3.8%. And the state of Colorado taxes the entire gain at 4.63, meaning that the grand total is about $20,232. Is that 30%? Yeah, $20,000 divided by the $68,000 total gain is 29.8%. That's close enough to 30% for me. So again, remember, when you sell investment real estate, it's about 30% capital gains taxes. So now we know something. You buy the property for 150, sell it for 200,000. The gain isn't just 50,000. It's actually more like 75,000, and it's made up of 2 parts. So when you do an exchange and the basis gets transferred from the old into the new property, you need to know that when you roll or defer the gains over in an exchange, you're rolling not 1 gain, but 2 gains get rolled over. All right. So here are the 6 rules of doing a 1031 exchange. If you want, send me an email and I can send out these rules to you in a more amplified format. So that's it for my 1031 portion. Is that okay, Nina? Or do you want me to talk about anything else?
No, I think that's good. Does anyone have questions, specific questions on the 1031 exchange? One thing I do want to bring up, if you're an investor and you have a property in Colorado, but you live out of state, there is a 2% Colorado state withholding that applies to people who do not live in the state.
And
Unless,
guess what? By doing the exchange, Nina, you can avoid that 2% withholding as well.
yep, exactly. But a lot of people are not aware of that 2%. And so I've got clients who are out of state and they're like, oh, I want to sell my property. And then I tell them about that and they're like, oh, so. All right, any questions before we move on? Okay, I think, go ahead. Tracy, you're talking
Okay.
very fast. So,
All right, I'm going to skip ahead and we're now back to the proposed changes to the tax code. So we're sort of back on target in a way. So 1031 exchanges, just to recap what I said previously, two completely different schools of thought about what Biden Harris want to do. They either want to completely eliminate it or they would limit it to only those people earning $400,000 or less. And we don't know what that $400,000 means. It might mean then that single tax filers, 200,000 or less would be able to use the exchange, and above that would not be able to. So let's talk about raising individual income tax rates. So just to be clear, we're done with 1031s. The next one on our list is that they are going to raise or want to raise individual income tax rates. Same story. They have two completely different schools of thought that they have been talking about. They are talking about or have talked about completely repealing all of TCJA, the Tax Cuts and Jobs Act. That means that the standard deduction may be removed. That means that 5 out of 7 marginal tax brackets would be raised. We just, who knows what else they'll do. Or the other school of thought is, and this is more recent, that they would only raise taxes on those earning $400,000 or more. Same problem as we talked about previously. They have not defined the $400,000 number. Is that married, filing joint? Is that single? What about corporations, sub S's, partnerships? We don't know. So raising taxes on those 400,000 above would mean raising taxes on at least the top 3 brackets. The 32% bracket would go up to 33 and maybe higher. 35% bracket may stay the same. And the 37% bracket would go up to 39.6, call it 40%. Let's just look at that top bracket for a moment. For Colorado residents, then, when you include state and federal income taxes, your marginal tax rate would be north of 44%. If you're a resident living in California or Hawaii or New Jersey, your highest combined federal and state income tax rate could be north of 60%. What else do we need to know? Exchanges, individual income tax rates, long-term capital gains. So let me just, this is not in the slide, but I should probably explain it. When you own stocks or bonds, or maybe you own some mutual funds, and they go up in value, you buy, the latest tech stock for $50, and it goes up to $75. It has gone up, it's gained $25 in my example, and that $25 would get taxed at long-term capital gains rate as long as you own that stock or mutual fund or bond more than 1 year. So that's capital gains on stocks and bonds and investment. The same thing is similar for real estate. You buy a piece of real estate. We've already looked at these gains when we looked at the previous slides on 1031s. You buy a piece of real estate for 400,000, and 2 or 3 years later, it's up to 475. That gain is 75,000. That's long-term capital gains. And how does it get taxed? Let's take a dive. This is going to be a little complex, but you'll see why in just a moment. They want to raise capital gains taxes on those people that make $1 million or more. Their capital gains would go from 20% up to 40%. In other words, ordinary income instead of capital gains. People earning 400,000 up to a million would still be continued to pay capital gains at the current rate of 20-some%. All right, let's take that deep dive. I just want to remind you, when you're talking about real estate, which is different than stocks or bonds or mutual funds, the capital gains on real estate is not 20-ish%, it becomes 30-ish%. Again, because you have that unrecaptured depreciation of 25%, you have the ACA, the Affordable Care Act at 3.8, you have the state of Colorado at 4.63. I think everybody gets it. Real estate's different. It's a higher capital gains, about 30-some%. Let's take a look here. I think that the changes that the Biden-Harris administration would result in 4 different tiers or layers of capital gains taxes. So for those people that are earning $0 to $80,000, married filing joint, today, right now, capital gains is at 0%, which would stay the same under Biden-Harris. It would be 0%. And oh, by the way, if you're talking about selling real estate and not stocks or bonds, then a lot of people say, when they call me up, they say, you know what, Tracy, I only make about 70 grand a year, and I'm going to sell this rental condo. I don't need to do an exchange. My cap gains are 0. That's true, except if your gain is, let's make it up, let's say it's $30,000 of gain. You make 70 and you say, don't need to do the 1031 exchange. You must then add the gain, 30,000 in my example, to your income. The income was 70,000 because they thought they were underneath that $80,000 limit. Well, 30 onto 70, now you're making 100,000. The first 10 grand of that capital gains would indeed be at 0%, but all the rest of it, 20,000, would be taxed at that 20% rate plus the 3.8 plus recapture of depreciation. So always call me regardless of your income levels. All right, so that's capital gains tier number 1. Tier number 2, or bullet point number 2, people that are earning anywhere between 80,000 up to 400,000. The capital gains is at 15% federal plus 5% as an average of all the states, resulting in the red, that 20% capital gains rate. And oh, by the way, people that are underneath 400,000 would still be able to use Section 1031. Great. Bullet point number 3, third tier of capital gains taxes. Anybody that's making 400,000 and above, up to a limit of $1 million, capital gains becomes effectively 30%. Well, that's on selling stocks or bonds or anything. That's 20% federal plus 5% tax plus the Affordable Care Act. And you don't get to use 1031 exchange because you make more than 400,000. If you're selling investment real estate, then the capital gains really is 30 to 40% for real estate. That's bullet point number 3. The fourth tier, bullet point number 4, is the following. People that are earning $1 million or more, again, they haven't defined that, the capital gains rate would be 50%, as you can see in the red. 40% federal capital gains. Wait a minute, where'd that come from? Well, that 20% capital gains becomes ordinary income. So right now, that ordinary income rate is 39.6%. They might change and raise personal individual income tax rates, which means that the capital gains, when it becomes ordinary income, could be a whole lot more than just the 40% number that you see right here. Effectively, that means capital gains when you're selling in real estate would be anywhere from 55 to 65%, and there's no 1031 exchange available. So that's a 4-tiered, what I think could happen, system if they change capital gains. Let me put this in spreadsheet format. Now, I'm not going to spend a whole lot of time on it because we've sort of slowed down and I don't want to lose the audience. I can even see Nina's eyes there. She's blinking slowly. I don't want to put anybody to sleep. I just want to give you what I believe to be good, valid information. Let's start on the left-hand side where it says long-term capital gains rate. This spreadsheet is exactly what I just told you in the previous slide, only it's in tabular format. Capital gains today are 0, 15, and 20%. But Biden-Harris would like to raise a fourth capital gains rate up to ordinary income, which might be 40% or more, for those people, second column, single, earning $1 million and above, or if you're married, filing joint, $1 million and above. People earning more than the $400,000 threshold would have to use the fourth column labeled ACA. You have to pay the Affordable Care Act on any capital gains. The next column where it says state income tax rate, state of Colorado is a pretty good example, 4.63, so that the total combined cap gains tax rate is either 0 or 20 or almost 30%, and certainly is 48%. That's for selling stuff that is not real estate, stocks, bonds, mutual funds. If you sell real estate, then you got to add the column labeled recaptured depreciation, 25%, so that the next column over is the combined or blended capital gains for selling real estate. You're looking at cap gains of north of 50 some percent. And can you do a 1031 exchange? The far right-hand column may not be necessary for if you're in the 0% capital gains rate. If you're above 400,000, it's not available to you. And certainly for the last two categories, no exchange is available. So that's my take. That's my prognostication on what they're going to do with capital gains. Is all that, that's a little summary. Does that make sense so far? Are there any questions? Have I put everybody to sleep out there? No, we're okay. All right, let's move on, because there are three more big significant changes. How am I doing time-wise, Nina?
You're good on time.
Okay. So we've talked about three of the big six. The next one is the estate tax. This may sound a little bit boring, but it can have some implications. Let me try and show you what those would be. When somebody dies, there is a federal tax on the estate. That means the value of everything that you own, your cars, your house, your mutual funds, your investment real estate, everything you own, your baseball card collection, your estate, its value. Well, under Trump, under the Tax Cuts and Jobs Act, that exemption from having to pay the estate tax. So the estate tax was kept the same under Trump as it was under Obama. It's 40%. If you have an estate greater than $11 million if you're single, and greater than $22 million if you're married, if everything you, in other words, you're pretty wealthy. If your estate is greater than that, then the amount of your estate above 11 million was taxed at that 40% rate. Anything below 11 million, no taxes. It's the estate tax exemption. If you're following me, what Biden-Harris wants to do is to drop the $11 million number down to just $3.5 million. So now if you die and your estate is worth more than $3.5 million, you will pay the estate tax. And oh, by the way, he wants to raise it from 40 up to 45%. Note something here for just a moment. This is the value of everything that you own, your wealth, when you die. The wealth tax being proposed by Senator Warren is the exact same type of tax, only you're still alive. It's a tax on everything that you own. All right, so that's the estate tax, the death tax is what a lot of people call it. All right, so we've racked up four big changes to the tax code. The fifth one, if you don't pay attention to anything else, this is one you really need to pay attention to. It's called a step up in basis. Here's what it means. It's been in the tax code since almost the very beginning. Section 1014, around 1916, 1915 is when they put it in the tax code. Here's why they put it into the tax code. Mom and dad own a farm or a ranch, or they have a small business, or they own some investment real estate. Maybe they own a fourplex. And when they die, you know, the kids, their heirs get the property. The heirs, the kids can make one of two decisions. They can sell the property. If they sell it, all the capital gains are wiped out. They're eliminated. They are erased. Why? The original basis, the purchase price of that property, steps up to fair market value, and all the gains are erased. Or the kids say, "Nah, we don't want to sell it. We would like to hold on to it and continue to rent out the fourplex or continue to run the ranch or the farm." And then when they sell it years later down the road, they will only pay capital gains on the amount of time that the kids actually own the property. Again, all the gains from when mom and dad owned it were eliminated. All right. So what Biden Harris wants to do is the following. When mom and dad pass away and the kids get the fourplex or the ranch or the farm or the business, and whether they sell it or not, the kids must pay the capital gains taxes. They're paying taxes on unrealized gains. This is exactly why it was put into the tax code. When mom and dad died, before all this step up in basis, many times the heirs were forced to sell the property simply to pay for the capital gains. Well, the step up in basis stopped that from happening. Step up in basis is going to be repealed under Biden Harris. All right, any questions at this stage? I think for me in 1031 land, here's what I tell people currently, and I've told them for 20 some years. You sell a piece of property and go do an exchange and buy another one. Maybe you do 2 or 3 exchanges. I have institutional clients that have done 20 to 30 some exchanges. Every time they're not paying, forwarding the capital gains of 30-ish some percent. Someday when that person dies, they're going to get a step up in basis and all the gains are wiped out. I call that in my business, swap till you drop, or defer until you die. That solution set in investment real estate will then be gone with the elimination of step up in basis. Questions before we hone in on corporate income tax rates? Any questions in the chat room, Nina? Anybody else? You're talking, I don't. Yeah,
I don't see any questions, but I did have a question that I know sometimes clients will ask me. If they have an investment property, it's been an investment for 10 years, they think they want to sell it in 2 to 3 years, can they automatically move back to the property, convert it to a personal residence, and then avoid paying any capital gains?
No. So I'm going to make sure I want to hear the fact pattern correctly. So they've had this rental property for 10 years and they say, well, we're thinking about selling it, but rather than do an exchange, I think I'm going to move back into the real estate, back into maybe it's a single family rental house, move back into it, live there for at least 2 years. Now I've turned it into my home and I get to use my personal home exclusion and all is good. Not quite. Moving back into it, living there at least 2 years, yes, you will turn it into your home, and yes, you will get to use your exclusion, 500,000. But those previous 10 years of renting it out, guess what you've had each year that is now built up? Unrecaptured depreciation. So that recapture depreciation is taxed at 25%, plus 5% to Colorado, plus 3.8% for the Obamacare tax. You're going to get taxed on the depreciation component. Remember, when you sell property, there's always 2 capital gains. That depreciation recapture gets taxed at about 30, 33 some percent. So a large chunk of your gains might be tax-free by moving into the property, but not all of it. You're still going to have a significant amount of gain to be taxed to be paid. Did that help, Nina?
Yes. Yeah.
Okay. So I don't see all the gallery. I've got it narrowed down to a little window. I hope everybody's not asleep. I've tried to not be boring. Perk up because we're almost towards the end. Corporate income tax rates. You may not care, but guess what? This affects real estate market because it affects corporations who do what? Hire people and give them jobs and pay them wages. So here we go. The before 2017, the corporate U.S. income tax rate was 35%, much higher than most other countries. TCA, Tax Cuts Jobs Act, reduced it down to 21%. Biden Harris want to raise it from 21 to 28%. Let's take a look at it visually. I took some comparisons here of other countries, Ireland, United Kingdom, South Korea, Japan, the US. You can see what their corporate income tax rates are. You can see in the red here, OECD, that's the Organization of Economic Cooperation and Development. It's an average of 42 countries that are, they're not third world countries, they're economically developed countries. So if you were a corporation, where would you want to put your headquarters? Would you want to put it in the United States, taxed at 39 some percent, or maybe Ireland at 12.5%? Well, Apple and several other countries tried to relocate some of their headquarters of various sub businesses in Ireland because of the low corporate income tax rate. Plus, Ireland's got pretty good beer. So, but the effective corporate income tax rate was 35%, but you include state and other taxes, it's 39.1%. So we were uncompetitive compared to the rest of the world. That means that corporations were leaving the United States through a process called inversion. They decided not to even locate here to begin with. So that reduced the investment in the United States, cost American workers their jobs, and potentially higher wages. The Tax Cuts and Jobs Act did the following. Trump wanted to reduce it down to 15%. Congress debated it. They came up with 20%. And truly within the last 30 minutes of debate, the Democrats forced it up to 21%. Okay, fine. So 21% has now been the corporate income tax rate for the last 3 some years. Biden and Harris want to do the following. They want to raise the corporate income tax rate from 21% up to 28%. Don't forget the state and local taxes. That would make it above 32%. That makes us then, once again, less competitive than China or the United Kingdom or Germany or Mexico or even Japan. And again, results in lower number of corporations wanting to locate here, lower wages for workers, and even reducing jobs. So the repeal, I'm going to sort of summarize here. They're talking about repealing or just limiting 1031 exchanges. They're talking about a complete repeal of the step up in basis. They're talking about increasing the capital gains rate up to ordinary income. So it could be much higher than 40%. They're talking about increasing individual income tax rates. They are talking about raising the corporate income tax rate. And of course, they want to increase the estate tax from 40 to 45% and decrease simultaneously the exemption from 11 million down to just $3.5 million. So let me just pause right there because there's one more proposed tax change that I think is real important for us in the real estate business, but is not in the big 6 that I just talked about. Are there any questions right here at this stage of the game? Going once. There seems to be somebody in the chat room. I'm not sure if that's new or an old chat. I'm just going to go on unless Nina says otherwise. This is
Tracy, so we do have a question. So somebody asked, all these possible restrictions, tax rates, inheritance, not making owning a rental property, rental investment fun in long run. Any better ideas?
So I think that the best investment right now, when you look at broad categories, you look at equities, the stock market, when you look at fixed income, bond market, when you look at mutual funds, when you look at gold, silver, commodities, when you look at interest rate derivatives, and then you look at real estate. Those are the 6, usually the big 6 categories of asset allocation. Real estate is the best place to be. Why? Right now, interest rates are enormously low. Never fight the Fed. Interest rates may go up because of inflation. What's the best asset that you can own? Better even than gold if inflation becomes a problem? The answer is real estate. Even with high capital gains and the elimination of Section 1031, investment real estate, I think, is still a superior asset class. So despite all this negativity, possible negativity, I think real estate is still a very good game. Am I answering the question?
Yes, I think you are.
Okay.
I do have a question. If I have a client who's thinking about selling to do a 1031 exchange today or waiting, till next year, what would you recommend?
Oh, I'd do it today. There may not be 1031s after a while. If you're going to exchange and defer the gain, get a new piece of property for whatever reason. Maybe you want a different location, you want a different type of property, you want more cash flow, you want more basis to increase your depreciation expense, whatever your reason is, don't pay the taxes, do the exchange, get it done now.
All right, thanks.
All right, so here's that bullet point list. We've got just a couple more things to cover. This is sort of like a seventh item, and it's the state and local income taxes, SALT, SALT. It's the deduction that you get to take on your federal tax return, on your Form 1040. You get to deduct the taxes that you pay for state and local and property taxes. So on this map, I've tried to show the fact that before the Tax Cuts and Jobs Act, this is a map that granulates down to individual counties. The people that were in low tax states, in the blue areas, the counties that are blue, were effectively subsidizing the income tax returns for people in high tax states, the ones that are in the pink, the red, the purple. Before SALT, people in low tax states were subsidizing people in high tax states when it came to state and local income tax deductions. But TCJA capped the deductions at just 10 grand. That kept people in low tax states from helping pay the taxes for people that were in high tax states. Biden wants to eliminate the SALT cap. That will happen. He will do it. And by doing away with the SALT cap, then we're back to people in low tax states, once again, helping pay for those people that live in high tax states, like people in low tax states like Wyoming and Colorado and Utah and Montana and Texas would be helping to pay for people in California or Oregon or New York or New Jersey or Virginia, et cetera. So I think that's important, just so you're aware of it. We've talked about these 6 big proposed tax changes. Here's a little summary. This is the largest permanent tax increase since World War II, $4.3 trillion. And it will not be spent at all on reducing America's debt, which is $27 trillion. Instead, it will fund new spending programs of a little over $11 trillion. What are some of these programs? I think people should know. 1.4 trillion is to expand the Affordable Care Act, bringing about a public option. We're going to reduce the Medicare eligibility age from 65 down to 60. That costs $300 billion. The Green New Deal, climate and infrastructure, is $2 trillion. Social Security, supplemental income, another $1 trillion. College, K through 12 education, preschool aid, about $1.5 trillion. This is where the money is going to come from to eliminate some of the student loan debt, family leave assistance, Buy America, etc. $11 trillion in new spending. So this is the last slide. Can we afford these new programs when we already have $27 trillion in federal debt? Now we're going to tack on another $11 million in new spending and raising taxes in the middle of a pandemic recession. These are questions that I think probably were answered. The ship has sailed on November the 3rd. So now all we can do is try and prepare ourselves or brace ourselves for impact. Okay, that is it. I might have finished a little bit early. I don't know. Nina, how are we doing?
Good. I have a question in the chat, so let me read it to you. I don't know if you know this. Can you touch on the Delaware Statutory Trust 1031 exchange? I don't know if you
Sure.
Anything about that?
So, oh yeah, when I was at an investment bank, Merrill Lynch, I helped create that product. So it's been around for a little while. So I'm going to set up the answer this way. You sell a piece of real estate, I don't know, a single family rental, or it's a fourplex, or it's a small 13 unit apartment complex, whatever it is. You sell, you do an exchange, and the person says, I'm 72. I've had a pretty good success in real estate. I know about 1031s, Tracy. I know about the 30% hit. I don't want to pay the tax, but let me tell you something. At 72 years of age, I'm not really sure if I want to own real estate anymore. You got any ideas for me? What else can I buy besides regular old real estate? And the answer is you could exchange into DST product. DST stands for Delaware Statutory Trust. So what the heck is a DST? Let's say you're driving down the street, you see a Starbucks on the corner, you drive a little bit further, you see a Walgreens, you go on a little bit further, and you finally stop at Home Depot to get your lumber. Every one of those examples that I just gave you, Starbucks, Walgreens, Home Depot, are examples of what a DST is. Starbucks does not own the building that it's in. It's a tenant. It pays for everything. It pays the rent, of course. It pays taxes, insurance, maintenance, everything. So that the real owner of that building that has Starbucks, they just sit back and collect the rent check, and they're pretty happy. That's a triple net lease. What about bigger stores, the Walgreens or the Home Depot that I just told you about? So a Starbucks goes for like $2 million, 2.2 million, something like that. Well, you go to a Lowe's or a Home Depot and you're looking at 13 million, 20 million, depending on the location. Usually they're not owned by just one person. They're usually owned sometimes by a DST, a syndicator. Someone has come in, bought that building. They are having Home Depot lease it out. They're a tenant. But what the DST wants to do is share its ownership so that other people, other investors, like the guy that's selling his sixplex and wanting to do an exchange, he can sell, let's say his sixplex goes for 900,000. He can buy a part of a fractional interest of a DST that owns a Home Depot. And it might own a Home Depot down in San Antonio, Texas. So great. The guy has now done his 1031 exchange. He's bought a small fractional interest in a DST, meaning he's done an exchange. He owns real estate. He owns a big trophy piece of property or a little piece of it. He sits back and just collects the rent check. It's a very passive investment, especially for someone who's older. DSTs can be a very good product. They have issues though. One of them is liquidity. When it comes time for you to sell your little fractional interest of a Home Depot down in San Antonio, what are you going to do? You're going to hop on an airplane, fly down to San Antonio, and slap a little for sale sign in the window and say, hey, listen, this window and the door belong to me. Anybody want to buy it? You can't do that. Liquidity is a big issue with DSTs. You usually have to wait until the DST syndicator sells the piece of property. That's usually somewhere between 5 and 7 years. So you're pretty well hooked in to that DST product for until that event horizon happens. Was that a good enough explanation? Nina, you be the judge, or maybe the guy in the chat room can follow up.
Yeah, I wasn't even aware of that. Craig, did that answer your question?
Yes, thank you.
Okay. Any other questions? Anybody want to ask me anything about anything, really?
Well, Tracy, thank you so much for being on. Wow, you've given me a lot of really great information that I didn't realize that there were so many tax implications coming on that's going to affect us with real estate. So it's definitely something to think about. And I think you're right. Real estate, even with the tax code changes, real estate's still a great place to invest. I mean, we've got appreciation of properties. We also have short-term cash flow from the rents. So it's a good place. So if somebody we're thinking about doing a 1031 exchange, would they reach out to you just to talk about possible tax implications and things like that?
Absolutely. You bet. Right there, my finger pointing in the right direction. There's my contact info. up over my left shoulder. So yeah, call me anytime with questions. Figuring out the basis gain, capital gains taxes, figuring out how to do the exchange, especially if you own the real estate, maybe in a partnership or an LLC